At the National Institute of Financial Education, we have what we call the Repay Smart conversation. And today I'm going to share some of the cornerstone concepts. I'm going to start by asking you a question. If what you thought to be true turned out not to be true, when would you want to know? Everything we know, we think is true. When something falls outside of our box of knowledge, we have two choices. Either ignore it or expand our box. Today, I'm going to introduce you to concepts that might challenge some beliefs you've held for a long time. My challenge to you is simple. Be willing to expand your box of knowledge. By the end, I hope you'll walk away with valuable insights that can help you in your financial future. So why talk about liabilities and house wealth? Willie Sutton was a famous bank robber, and when asked why he robbed banks, he profoundly stated, because that's where the money is. For most Americans, our house is both our largest asset and our largest liability, so it's important to properly manage it for our big picture financial plans. If you want a more qualified expert than Willie Sutton, how about Rick Edelman? He was a founder of one of the nation's largest investment advisory firms. And in his book, he states, how you handle the purchase, financing of your home will have far-reaching implications on virtually every facet of your financial life, including your ability to save, pay for college, and plan for retirement. Basically, it boils down to net worth, which equals assets minus liabilities. When people do take the time to look at their finances, most people focus on increasing their net worth by increasing their assets. But increasing net worth by minimizing liabilities often has a more profound impact and ultimately allows you to supercharge the asset side. Throughout your lifetime, you'll face key financial milestones, and a good portion of our adult lifespan will have financing options, from college financing, home loans, and credit card debt. Each of these moments presents opportunities to make decisions that will directly impact your financial security and freedom. I'm with my clients for the life journey because life changes directly impact your financial situation, so it's important to adjust your plans accordingly. If we were to play a little word association, the word home will often bring up ideas like the place we raise our family, our neighbors and friends, security. These are all emotional components of the place we live. The word house, on the other hand, is more likely to conjure up the more rational side of the place we live. The house as a physical shelter. And when you buy that shelter, you get a certain set of situations. You may now have a mortgage, and you might have leverage on an investment for the first time in your life. You might now have tax benefits and your wealth increase through appreciation, as it will most likely diversify your assets. It's important to keep both of these in mind and be sure to tap into the rational side when making financial decisions. If you make wise decisions around the house, it could dramatically enhance your experience of what we call the home. Location, location, location. I'm sure you've heard that term before, particularly around real estate, and we think of it as where we want to buy. There are the home components of being in a nice neighborhood, a good place for our children, easy shopping access. But since we're buying an appreciating asset, we also want to think about the house side. Think about buying where we are likely to get a good return. Perhaps think about what the area property taxes are. Are there work opportunities? We have our own version of location, location, location. The fact is, we all live lives of cash and cash flow, and it's critically important to consider the location of that cash flow. You are the CFO of your own personal economy, and your cash flow decisions affect your wealth. On average, 52% of our income is going towards committed expenses. Things like what it costs us to live, whether it be a mortgage or rent, taxes, insurance. 46% goes to discretionary expenses, whatever else we're choosing to spend money on now. And that only leaves 2% going into savings. What we're deciding anytime we're dealing with our money and our cash flows is, Are we going to spend it on lifestyle today, or save it up, which is generally saved for lifestyle tomorrow? What we're always looking at doing, especially with managing liabilities, is there anything out there that we can minimize to decrease our committed expenses? Then we have the decision of either increasing or maintaining our lifestyle today and increasing or maintaining our lifestyle tomorrow, or our savings. So I work with a couple. I help them decrease their committed expenses to 48%, saving them 4%. They decided that they were okay with lifestyle today, so they were going to go ahead and maintain that 46%. They were able to take that 4% and put it towards savings. So now they've bumped that up to 2%, which increases their savings by 200% by getting it up to the 6% savings rate. Now, you might ask, well, how much do you need to find in order to actually have a significant impact? The median savings amount for a 65-year-old today is $200,000. In this case, if we could have found that person just 150 extra 30 years ago when they were 35, they would have almost doubled that savings. If we could have found them $250 a month, they would have over $500,000 now saved. Now, they could have used that extra money to pay the mortgage off earlier and then start saving. The question, of course, becomes, what makes the most sense? How do we really decide highest and best use of cash and cash flow? In the chart, the money was being saved and then the house was being paid off when the savings account was as much as the mortgage balance. So at $250 a month, that was 18 and a half years. Why not pay the extra directly to the mortgage? Well, in this case, the mortgage got paid off faster by saving the money separately instead of making the extra payments. Plus, they had the safety of not having the money tied up in the house. We'll get into this more later, but I wanted to illustrate the importance of looking at all the options of what your money could be doing. I want you to think about how you would answer these questions. A large down payment will save you more than a small down payment. A 15-year mortgage will save you more than a 30-year. The interest rate is the main factor. Making an extra principal payment saves you money. Now, I gave away a little bit of this last one on the previous slides. This is kind of what I want you to start thinking about. This is the area where you might need to get a bigger box, because I'm going to be challenging some things that we all think of. These might be true if we're just looking at a mortgage, but mortgages don't live in a vacuum. They're part of a much larger financial plan. So it's important to see how financing that mortgage affects everything else. It's also important to acknowledge that everyone has their own money story. It starts getting developed by our parents, and as we get older, by our communities, schools, the news, and so on. It's important for everyone to flesh out what their story is and where it came from, because it's going to impact everything you do. The emotional side that comes from your story might blind you to what might make the most rational sense for you. Safety, liquidity, and return. These are pretty well-known financial planning concepts, the three-legged stool of investments that we are always trying to balance. We understand that oftentimes safety and return are opposite sides of a teeter-totter. I think liquidity very often gets overlooked until we want the money. You've heard me say now, we all live lives of cash and cash flow. Part of what we do at Knife is to help people bring these financial concepts into their everyday decisions around money. And in this presentation, we'll be focusing primarily on how these concepts tie into our house wealth. Safety. Safety is the risk of loss of your money. And when we're looking at the house, there are some threats to that. The first one that comes to my mind is appreciation, but I would imagine for most people that's not necessarily something you think about, because we all want our houses to appreciate. But you have to think about the fact that when our house value goes up, it's only benefiting us if we want to sell that property or borrow against the equity. Otherwise, it's just making it more expensive to live there, because property taxes go up and homeowners insurance go up. So as long as we're still working and our income is keeping up with that, we're fine. But if we are on a fixed income particularly, it can become a bit of a challenge. Now, obviously, we don't want our houses to depreciate in value. And foreclosure is something that, well, we're all hoping we never have to face. But an interesting thing about foreclosure is that if in these smaller towns, say around Montana, if a major employer happens to close and a lot of our neighbors are getting foreclosed on, there's a good chance that it's going to depreciate values in the area, and so that'll affect us too. Now, again, as we are thinking about protecting against the risk of foreclosures, it's definitely something to consider and make sure we're shoring up against. And the fourth one is lawsuit. Now, if you're a homeowner, make sure that you have your homestead declaration on your property. It'll help protect you in the event of lawsuit. And if you're buying a home, we'll certainly make sure that we get one on your primary residence. Liquidity is the use and control of your money. Now, you can only access the money in your house in two ways: by selling it or by borrowing against it. Now, the challenge with that is if we need to borrow the money, we are not going to be able to do that if our need has affected our ability to repay a loan. Say we've lost a job or something like that. The lender is going to say, and at that point, it doesn't matter how much extra you've ever paid towards your house payment. You can't say, well, I've been paying you extra every single month, so now you're going to let me slide. It doesn't happen that way. So it's really important to think about the liquidity of our house and where our money is to make sure we don't end up house rich and cash poor. This slide is actually from another course of mine, Cash and Liability Mastery, and one of the things we really focus on there is the importance of whatever our committed expenses are, and a good chance are discretionary expenses since things like food fall into that. We need to have a month's worth of that times 3. So 3 months supply, 90 days, somewhere that we could access it. Why 90 days? Well, statistically speaking, that's the amount of time it takes people to recover from a job loss or an illness or something like that. So it's a really good idea to make sure you have that. Now, you have a lot of different ways. It doesn't mean 90 days worth has to be in a bank account. You could have a HELOC in place that you know that you can grab from if you need to. But the time to get that in place is before you need it. You may have a life insurance contract you can loan against or a 401k loan. But the importance is to know how quickly you can access that money and know that it's there for you. Now, we're into return. This one is a pretty big one to unpack. So, the growth of your money over time. Money inside the house can increase in only 2 ways. Appreciation, which is market dictated, or the principal, which is the amount that you are putting inside of it every single month. Now, it's important to make a distinction here. Principal is you locating money inside the house, but it's not growing your money, just what's inside the house. Think of it this way. You have a bank account. You put $100 in it every single month. The balance of that account is increasing, but it's balance sheet neutral because you're just taking that money from one spot and putting it into the bank account. The only way the money in the bank account is growing is if you're earning an interest rate on that, and the bank is also contributing to the amount in there. So it's very important to make that distinction with the house, and we'll dive into that a little bit more in the next slide. As we're looking at our houses, though, as an investment and the potential return, we also want to factor in effective percentage rate and liability asset gap and the opportunity cost of what else our money could be doing for us. So this is getting a little deeper into that return and appreciation versus the amount we're putting into it. So we bought a house that was $400,000. We had $80,000 to put down, and so we got a loan for the rest. The rate on that loan was 7%, and we're going to assume a 4% appreciation. So we keep that same house in loan for 30 years. At the end of 30 years, the house is paid off, and it's worth $1.2 million. Now, how much did you make on that house? You may be thinking you made $1.2 million. But you have to remember, you put $400,000 of your own money into that house over those 30 years. So your actual increase is $897,000. That's the amount you made by owning a house. If we look at this a little different way and strip out appreciation, you buy a house for $400,000. There is no appreciation, so at the end of it, it's paid off, but your house is still only worth the $400,000 that you put in there from somewhere else on your balance sheet. When we get into opportunity costs, now we're going to say, well, if I had the money to pay cash or the extra money to put towards my mortgage or whatever that happens to look like, doesn't that make the most sense? Aren't I the best off by paying off my house? Well, let's look at it. You're going to buy a $400,000 house. You have the cash. You can put it down, but you know you want to replenish that savings. So you're thinking about, well, okay, what would it cost me if I were to get a mortgage? And you find out it would have been $2,600 a month. So you say, okay, I'm going to invest that every single solitary month for 30 years. I know I can get a rate of return of 7%. At the end of 30 years, of course, your house is free and clear, and now you have $2.5 million in an account. That feels pretty good. Now, one thing here when people say, well, I'm going to start paying, saving, is discipline risk. Now, if you're somebody who had saved up $400,000, there's probably not a lot of discipline risk for you. But if the money that you're using to pay down the house was given to you or something like that, it's important to think you'll probably pay your mortgage every month, but will you actually put that savings aside every month, or will you let life happen and suddenly things become more easier to spend money on? So we're going to compare this to financing that house 100%. You get a $400,000 mortgage. Cash flow, you're exactly the same. You're putting aside $26.61 every month here, and you're paying $26.61 to your mortgage every time. Balance sheet neutral because you still have the $400,000 asset. On the one hand, it's offset by a liability. Here you just have the asset and no more cash on the other hand. When we take that $400,000 though, now we can take that whole amount and invest it at the 7%. So now at the end of 30 years, we still have a free and clear home, but now we have $3.2 million in the bank. So we ended up over $500,000 better off actually by financing. So this is one of those things that come into play. Really look at all the options. Now I was curious when I did this because this is just going 7%, 7%. Okay, what would it look like if it would have been in the market? So I decided to go ahead and backtest it using Portfolio Visualizer and saying if either the $26.61 a month in the first illustration or that $400,000 lump sum was getting invested in the S&P 500 from 1993 to 2023, what would it have looked like? And in this case, both scenarios ended up better off. Still, though, obviously the $400,000 invested is netting you more. So let's dive a little deeper into why this happens. And it's because of the power of compound interest. So I love this slide. This also is from my COM course. And if you have children, I recommend taking a picture of this and hanging it up on their wall somewhere to keep this in their heads when they're making their money decisions. Billy got a job when he was 15, and he was told about the power of compound interest. So he saved every year, and he ended up saving up $15,000. He was able to invest it at 10%, and he left it alone. He never touched it again, never added to it, but never took from it. When he was 65 years old, he had $1.6 million there for him. Kim, on the other hand, she spent 39 years saving $3,000 a month. She was diligent. She saved every single solitary year, and $117,000 of her own money ended up in that account. And yet, she ended up $300,000 less than Billy, who had only invested $15,000. How does he end up with that much with only a $15,000 investment? It's because he had almost 7 doubles over this time period. What do I mean by almost 7 doubles? Well, we have to look at the rule of 72. If we want to know when $100,000 at 10% investment will grow to $200,000 or double, we take the number 72 and divide it by the interest rate we'll be earning, and it tells us the number of years. So if you were to inherit $100,000 when you were 20 years old and invested at 10%, by the time you're 27, it's $200,000. Now that doubles again in the next 7 years, and by the time you're 34, you have $400,000. That keeps going. Now, if at any point, you at 27, you say, well, this is pretty good, I'm going to start living off of the interest, you can certainly make that decision. This is a pretty powerful illustration of giving your money the chance to actually start growing and compounding. I'm a big college football fan, and they always do the field goal kickoff challenge. And of course, these are kids in college, so around 20. And if you make the kick, you get $100,000. And I always wish I could be there and slide this chart in front of them. So again, as we're figuring out what else we could be doing with our money, it's important to look at all of the things our money could be doing for us. And that's where liability asset gap comes in. So if you pay down a 7% debt, you're saving 7%. That feels good. You're saving 7% in interest you would be owing. However, if the money you used to pay it down was making 5%, then you have to keep in mind that you were actually only saving 2%. Now, you were still saving, so that's good. But if we flip this around and you paid down a 5% debt, you save 5%. But if the money was earning 7%, then you actually lost 2%. So for anyone watching this who has one of those 3-4% mortgages right now, and oftentimes money markets are making 5%, if you're paying extra on your mortgage, stop and think about that for a minute and see if it's actually in your best interest. Another one is the effective percentage rate. It's a key concept used to calculate the true net cost of borrowing when factors like interest rates, tax benefits, and alternative investment returns are considered. It's an essential tool for understanding and managing debt effectively, particularly when optimizing cash flow and wealth creation in real estate. The calculation for EPR is the nominal interest rate minus the nominal rate times your tax bracket. So let's look at an example. In this scenario, Jack sold his house and is planning to put the $40,000 he made into his new house. But he currently has $20,000 in credit card debt. Now, fortunately, he came to me and we looked at his whole big financial picture when trying to decide what made the most sense for Jack to do with the proceeds from his previous home. His credit card debt was at 18% interest. There's no tax deduction, so the EPR is 18%. His mortgage was at a 7% nominal rate. Now, right now, because of the increase in standard deductions a few years ago, the decision stops here for a lot of people because they don't itemize. So even here, though, he is saving significantly by paying down that credit card debt and putting less towards the house. But there are definitely those who do still itemize their deductions, and Jack is one of them. So Jack's in the 30% marginal tax bracket. When we figure out his effective percentage rate, now it drops to 4.9% on that mortgage. So now there's really quite a debt in paying off that credit cards versus the money that his mortgage will be costing him after the tax benefit. When we think about borrowing, we usually think people borrow because they have to. But as we've gone through this, I hope you can see that borrowing smart can actually allow us to grow our wealth. An investor often chooses to borrow, especially when it can be done to leverage an appreciating asset. As we've gone through this, I hope you can see that when creating a financial plan, it's as important to look at the liability side of the equation as it is the asset side. Whether you're planning for college, preparing for retirement, or figuring out how to pay for insurance, be sure to look at the big picture. At the National Institute of Financial Education, we want to combat the missing and misinformation around how we manage our money. The problem is the mortgage industry looks at eligibility without considering suitability. Companies like Rocket and Quicken sell mortgages like they're a TV, and there is some best price without considering the overall impact on your wealth. I wanted to empower you with some of the key concepts so you are better equipped for all decisions that are made around how to own, finance, and pay off real estate. I like this cartoon. The guy goes to a financial planner and says, I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. The time to start planning and saving is now. I hope you found this information useful, and I'd love it if you'd reach out so I can help you with your plan.